So I'm going to walk you through our homework. So this one, KCC 1-1, determine the missing amount within each independent circumstance. So if the basic accounting equation is assets equal liabilities plus owner's equity, these questions here are pretty basic. So what we would do is we would take the total assets. So here we have assets of $130,000 and we have liabilities of $72,000. So you would subtract the liabilities from the $130,000 to get the owner's equity. So if we subtract $72,000 from the $130,000, our owner's equity would equal $58,000. So I'm not going to walk through each one, but I'm just going to give you examples here. I'm going to show you how to calculate these ones here. So we're going to examine 3 independent circumstances and determine the ending balances for assets, liabilities, and owner's equity based on the information provided. So I'm going to give you 2 answers here. You can figure out this one. But beginning of year, assets are unknown, liabilities equal $21,500, and owner's equity equals $40,000. So we start out with X is assets, we have $21,500 in liabilities, and we have $40,000 in owner's equity. So now if we add these two together, we know that our assets equal $61,500. So if during the year assets decreased by $8,200 and owner's equity increased by $1,300, we subtract this from the assets, the $8,200, and we add this to the owner's equity, the $1,300, and we get assets of $53,300 and owner's equity of $41,300. When we subtract the $41,300 from the assets, we find out that our liabilities equal $12,000. Number 3, beginning of year, assets equal $110,000, liabilities are unknown, and owner's equity is $78,000. So during the year, liabilities decreased by $12,000, and owner's equity increased by $6,400. So we have $110,000 equals X plus $78,000. So we subtract the $78,000 from the $110,000 to get our liabilities of $32,000. Then we subtract the $12,000 because it decreased by $12,000 and owner's equity increased by $6,400. So we get liabilities of $20,000 and owner's equity of $84,400. When we add the $20,000 and the $84,400 together, we get assets equaling $104,400. So that's how you complete those. If you got number 1 wrong, if you've already completed and submitted homework 1, go ahead and redo it and submit it again. Now these are a little more advanced. So I'm going to give one example so you can work through the other 2 questions. The end of the second year, assets equaled $41,000. Liabilities equaled $23,000, and owner's equity was unknown. So if we solve for owner's equity, we take the $23,000 and we subtract it from the $41,000 to get $18,000 in owner's equity. During the second year, assets decreased by $12,000 and liabilities decreased by $1,800. So this is where it's tricky. It says decreased during the second year. So we're working backwards. So we have to actually add this 12,000 back to the assets and add the 1,800 back to the liabilities. So with doing that, we get assets of 53,000, liabilities of 24,800, and owner's equity equaling 28,200. So now we see here during the first year, liabilities increased by 1,100 and owner's equity decreased by 8,000. Now remember, we're working backwards because this was during the second year. Now we're going to the first year. So during the first year, liabilities increased by 1,100 and owner's equity decreased by 8,000. So we have to subtract the 1,100 because it's the opposite of increase because we're working backwards. And we have to add the 8,000 because it's the opposite of decrease. Again, we're working backwards. So we have liabilities of 23,700 and owner's equity of 36,200. When we add those two together, we get assets of $59,900. So that's how you would complete these two questions here. Alright, now when we're looking at accounts, revenue and expense accounts are always part of owner's equity. They're on the income statement, and net income is part of owner's equity. Accounts receivable is an asset. Notes payable is a liability. Inventory is an asset. Prepaid rent is an asset. Unearned revenue is a liability. Alright, and we'll talk about this further in the class. Alright, write one or two sentences describing the difference between the two listed accounts. So I'm going to give you an example here. Utilities expense and accounts payable. Utilities expense is an expense account. It's a part of net income, which is part of owner's equity. Accounts payable is a liability account, and that's part of the balance sheet. You can walk through all of these. I'll just go further down and give you an example here. Determine which accounts have been impacted by each transaction and by how much they have either increased or decreased. Alright, paid receptionist salary. So we have our salary expense being impacted, and we have our cash account being impacted because we're paying $500 cash for the salary expense. So we have the salary expense and the cash account being impacted. Alright, I provided you with an Excel sheet, and I will make another screen recording showing you how to record those transactions, but I want you to be able to put in the functions on Excel. So I really want you to be able to put the formulas in on Excel in order to get the balance sheet equaling out. So we want the balance sheet to, or the basic accounting equation to equal. We want assets to equal liabilities plus owner's equity. So I want you to put the formula in on the Excel sheet, but I will show you how that's done in the next screen recording. Alright, so KCC 1 through 7, record transactions. There's an Excel sheet provided for you. What I really want you to do is input the formulas because I want you to understand how to input formulas on Excel. Alright, so if we see that Jane Griffin wants to start a company, she wants to start a sporting equipment delivery service. She invests $45,200 to open her new delivery service. So the two accounts that are going to be impacted are your cash account, $45,200, So that would be an increase. And Jane Griffin's capital account of $45,200, and that's an increase. That shows that she holds $45,200 of interest in the organization. All right, so those are both increases. The next purchase or transaction, the company purchases a van for $25,500, signing a note with the bank. All right. The van is worth $25,500. So that is an asset. So we put it under vehicles or equipment, and that's $25,500, and that's an increase because it's worth $25,500. So it's an asset. So we put $25,500 under vehicles or equipment. Now, Jane is going to owe the bank this money. So she owes the bank $25,500. So we have to put under notes payable, which is a liability, $25,500 under notes payable because she owes that money. Right? So that is a liability. The next transaction, the company purchases supplies for cash for $400. Alright, so we got two accounts being impacted, the supplies account and the cash account. The cash is a decrease because Jane paid $400 for the supplies, so there's a decrease in the cash account of $400. So you put the parentheses around the 400 to indicate that it is a negative, right? And we have our supplies account increasing of $400 because it is an asset. It is something of value within the organization. So we have $400 under the supplies account, and that's an increase. Alright, so Jane performed her first delivery. She delivered sporting goods for $800 cash. So we have two accounts being impacted here. We have our cash account increasing by $800 because we were paid cash for that delivery service. And we have our service revenue account being impacted, and that's an increase of $800 in service revenue. Our next transaction, number 5, Jane performed another delivery service for $4,000. She delivered a $4,000 worth of sporting goods, and this was on account. On account. So we have two accounts being impacted. We have accounts receivable being impacted, and it's an increase of $4,000 under accounts receivable because we are owed that $4,000. So we are owed $4,000 under accounts receivable. And our service revenue account is being impacted because we received that revenue. We didn't receive the actual cash, but we earned that revenue, right? So we earned $4,000 of revenue. So we have our revenue account increasing of $4,000. Our next transaction, number 6, the company pays $110 for telephone expense. So we have cash going out of the company because we're paying the expense. So we have a decrease in the cash account of $110. And we have our telephone expense account being impacted. And expense accounts always decrease owner's equity. So we have parentheses around 110 indicating that it is a negative. So that decreases owner's equity. Those are the two accounts being impacted on that. Transaction number 7, the company makes a payment on the van purchased. The payment is $625. So that, again, cash is going out, so our cash account is being impacted, and it's a negative $625. We got parentheses. and our notes payable is going down. We're paying off this note, so notes payable decreases by $625 because we no longer owe this $625, right? Number 8. The company collected $2,500 from the customer on account. Alright, so we have cash coming in of $2,500, so it increases the cash account by $2,500. And we have to note that we no longer are owed that $2,500, so we take that out of the accounts receivable account. So it's a negative $2,500 under accounts receivable. Number 9. Transaction number 9. The company pays $750 for employee wages. Again, $750 is going out of the company. Cash is leaving the company. So you have a decrease in the cash account of $750. And you have your wages expense, which expenses, again, will always decrease owner's equity. So you have a negative $750 under wage expenses. Our last transaction, Jane withdraws $1,500 from the business. So she withdraws $1,500 cash. So our cash account's being impacted by $1,500. So you see $1,500 going out of the cash account. And Jane Griffin's drawing account is being impacted. And the drawing account is always taking away from owner's equity. So $1,500 is being taken out, and you see it in negative. So that always decreases owner's equity. Alright, so when we do the formulas, we add all these accounts together. You see equals sum C2 through C11. We add all those together to get $45,115 in the cash account. Accounts receivable. We do the formula and we get $1,500 under accounts receivable. Our supplies. Our supplies are worth $400. Our vehicles are worth $25,500. We have nothing under accounts payable. Our notes payable is down to $24,875. Our Jane Griffin capital is at $45,200. Our Jane Griffin drawing account is a negative $1,500. Our service revenue account is up to $4,800. Our telephone expense is at $110. And our wages expense is at $750. So if we were to record the assets, liabilities, and owner's equity, we could come down here and make sure that they all equal out. So we have assets, so we do equals sum of all our asset accounts, so these accounts here, equals sum of this account, this account, this account, and this account. So we have $75,515, and then we have our liabilities equals sum of our liabilities. So we got liabilities here. And we got our owner's equity equals sum of owner's equity, which is our capital, our drawing, our revenue, our expense, and our telephone expense, and our wage expense. So now if we add these two together, we have equal sum of this and this. What do we have? Oops, what happened there? Sum of this and this. And we have $72,515. So our basic accounting equation is in balance. Our assets equal our liabilities plus our owner's equity.